We see our high-income earning women and couples making 3 common mistakes with their healthcare savings accounts here at Spark Financial Advisors. My name is Lauren Zangardi Haynes, and the 3 primary mistakes we see people making are: 1, they're not fully funding their HSA. So if you're already in a high-deductible healthcare plan and you've decided that that makes sense for you, make sure you're maximizing your HSA, because, as you know, it's triple tax preferred. So you get the tax deduction up front, it grows tax-free, and then it can come out tax-free for qualified healthcare expenses now, or you can let it grow and compound into retirement. If you get into retirement and you don't have any healthcare expenses because maybe you're like a vegan yogi, then at age 65, you can take those funds out of your HSA and treat them just like a regular IRA. So you won't pay a penalty on it, but you would pay income taxes on those distributions. But let's get back to the other mistakes. So, second mistake, people are putting money in their HSA, but they're leaving it in the bank side of the HSA product. Almost all employers offer a linked brokerage account to an HSA, but you're defaulted into the bank account side of the HSA product. If your HSA account at your employer does not have a brokerage arm available to it, you can open your own brokerage account and transfer the funds to that brokerage account. It's really important, because what we wanted to do is maximize this wealth building of potential of this HSA, and we're just not going to get there in the bank side. Now, important caveats. First, this assumes that you have cash that you can use to pay for ongoing medical expenses from cash flow, right? So for my high income earners, this is you. And then the second one is that it assumes you have an emergency fund available as well, because if you have a high deductible healthcare plan, you may have a year where you have a lot of out-of-pocket medical expenses, and we want to make sure that the money you need to cover that is not sitting in an investment account, right? Because if the market sells off, then we have some problems. Third mistake that we see is that because the HSA is like mentally earmarked for healthcare expenses, people don't want to spend from cash flow to do that. And so they are using the HSA on an ongoing basis to pay for the medical expenses. And really that means they're leaving actually a lot of future compound tax-free growth on the table. And so we typically encourage our clients to protect the HSA money, spend from your ongoing cash flow, so that you can let that HSA grow and compound and be there for you when you are ready to retire, hopefully before age 65. Thanks so much for watching.